In June 2026, the fragile security arrangement holding the Middle East together collapsed, triggered by a localized military flashpoint. This flashpoint erupted just off the coast of Iran's Hormozgan province. The Islamic Revolutionary Guard Corps broadcast a highly calculated video showing a precision-guided ballistic missile launching from a mobile unit near Sirak Island. That broadcast provided visual confirmation of a retaliatory strike, targeting the immediate vicinity of a United States telecommunications tower situated on the island. A direct strike against an American installation ended the era of proxy skirmishes, bringing regional powers into open, direct confrontation. The video carried an explicit text overlay, declaring that IRGC missiles and drones were, quote, locked on American targets in the region and aggressor enemy ships. Accompanying this visual was the last soldier ultimatum, delivered by Iranian Armed Forces spokesman Abolfazl Shakarchi directly to the Trump administration. Shakarchi warned that any violation of the pre-existing ceasefire would result in new, offensive, surprising, and stormy scenarios directed at American regional bases. Tehran established a rigid baseline for de-escalation. The United States had to lift all economic sanctions, paid billions in war reparations, and formally recognize Iran's authority over the Strait of Hormuz. Tehran's terms effectively turned the world's most critical trade artery into a bargaining chip for war reparations and political recognition. This 3D tactical map illustrates the bottleneck at the Strait of Hormuz. At its narrowest point, the waterway spans just 21 miles. Following the Sirak Island Strait, the IRGC transmitted warnings via VHF radio, explicitly denying commercial vessels permission to navigate these lanes. By declaring the waters unsafe, Iran created a lethal hazard for any vessel attempting the passage, without requiring a formal legal blockade. The financial mechanisms governing global shipping reacted instantly. International protection and indemnity clubs withdrew their war risk coverage for the entire strait. This line chart overlay demonstrates the immediate logistical outcome. Within a 48-hour window, commercial ship traffic plummeted by 70%. That drop effectively halted 20 million barrels of oil per day, a full quarter of the world's seaborne trade. By forcing insurers to pull out, the IRGC weaponized the strait through financial risk, achieving a shutdown faster than naval mines ever could. Beyond crude oil, the closure trapped the massive vessels carrying liquefied natural gas, accounting for 20% of the entire global supply. This data visualization looks at May 2026 ship tracking figures. Against a normal monthly baseline of 100 LNG cargoes, only 7 successfully transited the strait. Qatari and Emirati LNG exports, which together comprise 19% of the global supply, remained stranded at port. The sudden loss of this 20% block of gas breaks the global energy supply chain. There is no short-term infrastructural alternative capable of replacing those volumes. The physical bottleneck in the Middle East almost immediately translated into a severe pricing shock across global financial markets. By the first week of June 2026, the International Energy Agency finally released its official emergency assessment. The IEA declared that the military conflict had escalated into a global energy security repricing event. European markets absorbed the initial shock, with traders fixating on the vulnerability of benchmark natural gas prices. This line chart tracks the Dutch TTF, Europe's benchmark for natural gas. As the deficit set in, the price spiked by over 60%. A price spike of this magnitude connects the regional military friction directly to the global banking system. The fallout extends to Asian markets, which serve as the destination for over 80% of the LNG shipments now blocked in the Gulf. Today, those vulnerable economies are facing immediate energy stress, spiraling inflation, and the physical reality of grid rationing. Without viable short-term alternative shipping routes, these import-dependent countries remain trapped by the logistics of the geography. The sudden severing of the LNG supply chain alters how nations will approach energy storage and international supply strategy moving forward. The June 2026 crisis illustrates a profound shift in the nature of modern conflict. Military control of a single geographic bottleneck provides decisive leverage over the stability of the entire global energy market.